Let's continue that theme of investment, especially in energy and especially in the transition to renewable energy sources. Last year saw Mike Cannon-Brookes Grok Ventures take a big stake in AGL Energy, and Canada's Brookfield Investments right now trying to take over Origin Energy. But future deals and investment might be tempered by government price caps on gas, especially as we've heard. Global management consultant Bain & Co has just released a comprehensive report on merger and acquisition activity around the world in the past year, devoting a significant part of that report to energy markets because in the first 9 months of last year, it made up around 27% of the deals. It does note that energy transition plus a need for fresh capital for the change in technology is driving this activity. Liam Connolly is Bain & Co.'s leader in energy and natural resources and joins us now. Liam, many thanks for your time. Is it actually of concern that changing government policy can create a disincentive for some of the deals being done to create the energy transition?
Thanks, Ross. I think government, the activity there, it provides an opportunity there. We see M&A activity in the energy transition as actually a long-term fundamental play. And so the underlying drivers that support investment in the sector are driven by the investment required in infrastructure, in services and in technology. And so given those are quite long-term factors, we actually see there's going to be continued demand for deals in this space moving forward as well.
So is there any coincidence that a lot of these deals are being done by private equity players who have the ability to take longer term views than publicly listed companies, which of course are beholden to quarterly and yearly results?
Yeah, we see two factors at play. We see some publicly listed companies are looking to divest certain parts of their business and focus on other parts of their business, which is spurring on some of the M&A deal activity in this space. But we're also seeing a large inflow of capital from private equity firms and infrastructure funds that are looking to fund the investment behind the energy transition. They see it as quite an attractive opportunity to invest in what we would say is sort of once in a lifetime build out of infrastructure in the space.
So it's interesting the coincidence of this because around the world, given the war in Ukraine and the rise in energy prices, you've got governments in the UK talking about super profits tax. You've got caps in prices in Australia. You've got other similar mechanisms around the world, government intervention. Normally that's a turn-off for any M&A activity as a result. And yet it seems as though, as you're reporting, that there's an acceleration of the deals. Why? I don't kind of understand. There seems to me to be some disconnect there.
That's right. We look at it twofold. We look at it firstly, what are the short-term factors? And we're seeing a lot of fluctuation in energy prices and a lot of activity in local markets. That isn't necessarily a deterrent for these long-term investment deals. We have seen that the actual underlying value creation opportunities from investing in these energy transition deals are actually outweighing the short-term fluctuations in volatility in energy prices. And so that's one of the fundamental drivers, which is driving the continued activity in last year and also the activity that we expect to see going forward as well.
So do you get any sense that if it was not for the war in Ukraine, if energy prices somehow normalised, if, say, for example, there was a resolution to that war and energy prices normalised, do you think the appetite for these deals would be the same? I mean, many people now appear to be almost banking on the fact that that war is going to be an extended one.
We do still feel that there is appetite there in absence of that war. While there has been some M&A deals which have been driven by commodity price highs and cashing out at the top of the cycle, that's only been a small proportion of the deals that have actually occurred. A lot of the other deals have actually been driven by long-term views around energy markets and the energy transition. And so in light of, if we do see stabilisation in those markets, we do still expect to see a high appetite to drive deal activity within the space.
Because one of the things that even Brookfield and, say, Grok Ventures have said when they've embarked upon their deals here in Australia is they've talked about the amount of investment that needs to come to fund the transition. That's part of the rationale, if you like, for actually making that deal in the first place.
That's right. There's significant investment required to transition from where we are today and move towards a path to net zero. We're seeing a lot of that come from private markets and private investors, as you've just touched on, with some of the deals that are happening right now. And we expect that trend to continue. There has been sort of a lot of dry powder available within energy transition funds. And given it's an attractive investment opportunity for private capital, we see that as actually an opportunity for the deal activity to continue in the space.
Okay, and one final one for you very quickly, and that is the threat of global recession. Normally, a global recession would depress these prices. They remain relatively elevated at this stage, and of course, the deal making goes on regardless.
It does. And a global recession can actually also present opportunities to invest behind some of these long-term trends. So I think in light of a global recession, while that can have an impact on valuations and funding, we're still seeing strong activity from the sector to actually invest behind that. So I think even though there will be some persistence around uncertainty as to what will happen in global markets, we don't see that as being a significant factor to slow down the M&A activity in this space.